Hey, welcome back. You're still watching Business Morning on Channels Television. Now, oil prices surged with Brent's bridging $100 a barrel. And that's the first time since 2014 as Russia attacked Ukraine, exacerbating concerns that a war in Europe could disrupt global energy supplies. After Russian President Vladimir Putin authorized what he called a special military operation, Ukraine's foreign minister said in a tweet that Russia had launched a full-scale invasion of Ukraine and was targeting cities with weapon strikes. Brent crude hit a high of $102.48 a barrel, the loftiest since September 2014. That's adding $5.22, while U.S. West Texas Intermediate crude futures jumped $4.85 to $96.95 a barrel after rising to as much as $97.40. That's the highest since 2014 August. Russia is the world's second largest oil producer, mainly selling its crude to European refineries, and is the largest supplier of natural gas to Europe, providing about 35% of the latest supply. Well, we have Adesola Sumoni joining us now from UK to tell us some of the implication of this invasion of Russia in the Ukraine, of course, in the oil space. Hello, Adesola. Good to have you second time this week.
Hi, Ini. Thank you for having me on the show.
Good to have you again. So oil prices have been volatile this week. First, it was a threat, prediction, wait and see, tension, and now finally we hear that Russia has invaded Ukraine, at least part of Ukraine. So first of all, what is this, seeing the position of Russia in the chain of oil production, what else can we expect from this?
Thank you for that question, Ini. So, like you mentioned, Russia is a huge producer of oil globally. I think they account for around 12% of global oil supply. And now with this escalation in Russia-Ukraine tensions, and with sanctions also coming from the US, coming from the UK, EU, Germany, I think it now is an issue of Russia, which is also a large supplier of natural gas in Europe, could then retaliate to these sanctions by cutting their supply, and that could have significant implications. Already, some analysts are saying oil prices reach as high as $120, $150 per barrel in the coming weeks if we see further escalation in Russia-Ukraine tensions. In addition to this, we are seeing a robust revival in oil demand growth to pre-pandemic levels. We are seeing record low levels of crude inventories in developed countries. So all of these factors are pointing to the fact that we also see OPEC Plus struggle to meet its production target of increasing output by 400,000 barrels a day every month. So all of these factors are pushing oil prices upwards. And if we see further escalation in Ukraine-Russia tensions, or if we see Russia retaliate to some of the sanctions that has been levied on it, then oil prices are going to even increase sharply.
Yeah, but we also have the ongoing talks with U.S., the nuclear talks going on there. So that's also one area that we could see supply. I mean, what effects can we expect from that area?
Okay, so like you said, the U.S. and Iran, they are reaching like an important point in the nuclear agreement. And if that is agreed, if the agreement is reached, then we might see some exports coming from Iran. I think around 1.3 million barrels per day coming out from Iran, but that is not likely to happen quite soon. So maybe later in the year, but that would moderate some of these effects. I think it will take off at most around $5 per barrel on oil prices. It would definitely moderate it. Also, we're expecting to see some oil coming from U.S. shale producers. Like I said, the higher oil price environment is becoming attractive for even high-cost shale producers. We're also expecting some oil coming from non-OPEC plus producers, such as some oil producers in Canada and Brazil. So this would moderate the rise in prices, but not so much.
Not so much. And then OPEC is meeting next week, the 2nd. already Nigeria and Iran have voiced that they don't think more outputs, the output should be increased. What do you expect from that meeting, actually?
Okay, first, OPEC has struggled to meet its targets already. So there's that. I mean, as of last month, the International Energy Administration said that, OPEC missed its target by around 900,000 barrels per day. Yeah. So there's that backdrop already. Also, we know that the oil market is tight right now. So there's kind of some incentive to increase. But I don't think at this moment, I do not think that OPEC would increase its target, because at the current levels, countries, many of the member states are struggling to meet. In Nigeria, I think our target is 1.7 million barrels per day. We are still only able to produce around 1.4 million barrels per day because of some vandalization on oil infrastructure. Same thing in Angola and some other countries. So I don't think OPEC would increase their production target for now. I think they will keep it stable, steady at 400 barrels per day. Also, remember I said that we're also expecting some oil to come on stream from non-OPEC plus members such as Canada and Brazil.
Yeah, so I mean, this would have been a very good time for Nigeria, if we're able to meet that quota. It would have really helped our reserve and helped us to pay a lot of debt. It would have been a good time for the country. Well, talking about other things now in the country, let's look at the naira. We see that the naira traded flat at the parallel market, 576 naira for a dollar now. And external reserves are up by $50 million. That's week on week. What's the outlook for this from your perspective?
I think without sounding like a prophet of doom, I think we are still going to see some pressure on the naira going forward, especially because as oil prices are still elevated and are projected to remain elevated for the foreseeable future, and that has implications for energy prices in developed economies, which is driving inflation in these countries. And I think that would trigger the central banks in these developed countries to move more aggressively to tackle inflation. So I think they'll hike their interest rate more aggressively, and that will have implications for emerging market economies such as Nigeria. It will probably lead to some capital flights, which will mount pressure on external reserves and the exchange rate. Already, capital inflows into countries like Nigeria are low. Also, Nigeria still has some FX backlog, with expectations of a tighter monetary policy. So all of these factors suggest that the pressure on the exchange rate will still remain. However, our external reserves are still a little bit robust at $39.8 billion, and the central bank would continue to inject FX into the market. Currently, they're injecting, I think, around $1.9 billion into the market monthly. So that would kind of ease some of the pressure, but the pressure will still remain.
Yeah, but so you can imagine what that extra dollar would have gotten from the crude oil would have done for us, in that case. Anyway, yes. So looking at the aviation sector now, domestic airfares are up. I mean, I listened to one of our reports, and some people say a flight now is about 100,000 naira, up 100%. In some cases, flight from Lagos to Abuja used to be 22. Now it's about 50,000. We even had that on our Sunrise program. I mean, this has a whole lot of effects, widespread effects on the economy, on Nigerians, on inflation, and a whole lot of things.
Yes, it does. I mean, if you talk to the airline operators, they will tell you that their cost of operations have increased. Also because as oil prices rise, the cost of even jet fuel is also higher. I think it's now around 420 to 450 naira per liter. It used to be around 190 naira per liter, I think, a year ago. So all of these factors are pushing the cost upwards. Now, in terms of the effect, we know that air tickets or demand for air flights are elastic. And in economics, say elastic in the sense that small changes in prices, essentially consumers are price sensitive. Now, around last year, we saw quite huge demand in air flights because of high security challenges on the road. I mean, you could be traveling from Lagos to Ibadan, and then you get kidnapped and whatnot. So we see a lot of people choose going to the air. But right now, with the sharp increase in prices, I think, given also the elasticity of air flights, or the elasticity of flights, I think that less and less people are going to travel by air. Already, you've seen some pictures or videos on Twitter, on Instagram, showing that we are seeing empty flights really because of that. So I think the first effect would be on airline companies. Their top line and their bottom line are going to take a serious beating, and also because so there's that. But also the people who will be affected most will be frequent travelers within Nigeria. I think the average Nigerian does not travel by air, because obviously of high levels of poverty. So I think those are some of the initial effects, and I think something really needs to be done in terms of to remedy.
Because we can expect that by the time inflation for this month comes out, all of this will feed into the inflation figure, and that will be the reality of the country, of the economy.
Yes, definitely. I mean, if this price sticks, not all price increases are inflationary, but if this price increase sticks, or if it lingers, then definitely it's going to pass through to inflation, and that would again have a multiplying effect on other costs or other prices in the economy.
Exactly. Well, okay. Well, talk us through some developments in the commodities space.
Okay, so talking about grains, wheat and corn, I think the geopolitical challenges between Ukraine and Russia would drive prices in the near term, because Russia and Ukraine are some of the largest producers of wheat and corn, particularly also for Nigeria, who is a huge importer of wheat. I think that's quite important, because if this tension escalates and it begins to affect Russia's supply of wheat and corn, then the cost of importing wheat and corn to Nigeria would also skyrocket. Already, the price of flour and other wheat-based products are elevated in Nigeria. So with this additional cost, I think that would also filter into domestic commodity prices. In terms of cocoa, I think the balance of demand and supply factors. For instance, we are seeing with the onset of rains, we are expecting better mid-crop harvest from some of the biggest producers in West Africa. Talking about Ivory Coast, Ghana, Nigeria, and Cameroon. And also, we are seeing on the demand side, we are seeing big demand coming from North America, especially as we approach Easter, with the Easter egg hunting season. I'm expecting big demand from North America, big demand from Europe. So I think the balance of this factor would determine the price. Also, we are seeing, as more and more countries lift the final restrictions of coronavirus, I think that will also be positive for demand for chocolate. And so I think overall, the demand is likely to marginally outweigh supply. So prices will still be a little bit on the high side. In terms of sugar, I think the big supply coming out of India is going to continue to moderate prices. So I think prices are going to remain under pressure, at least sugar prices in the near term.
All right, Adesola, thank you so much for giving us a wrap-up and update from the global commodity space, and enjoy the rest of your day.
You too. Thank you.